Your bookstore makes $2,000 in profit, but your accounts show a $7,000 profit in December and a $5,000 loss in January. It's the same business, the same numbers, so what's going on? Hello there, I'm James, you're watching Accounting Stuff, and in this video I'll attempt to explain the difference between cash and accrual accounting in less than 2 minutes. Start the clock. Before we get into the methods, there's one idea you really need to get your head around. Profit and cash flow are not the same thing. Profit measures whether a business has earned more in revenue than it has incurred in expenses. And cash flow measures how much cash has actually moved in or out of the bank account. A business might make a sale today and receive the cash later, or use a service today and pay the bill next month. So the question is, when should revenue and expenses be recorded? When cash changes hands, or when the work is actually done? This is where accounting methods come in. These are the rules businesses use to decide when revenue and expenses should be recorded. The two main methods are cash accounting and accrual accounting. What is cash accounting? Under the cash method, revenue is recorded when cash is received, and expenses are recorded when cash is paid out. Basically, it follows the bank account. If a customer pays you today, you record the income today, and if you pay rent today, you record that cost today. This makes cash accounting simple. Your records match your bank account, so it's easy to check where you stand at any given moment. And because it's straightforward, it costs less time and money to maintain. That's why it's a popular choice amongst small businesses, freelancers, and sole traders who want a straightforward way to manage their records. But there's a drawback, and it's a biggie. Because cash accounting only tracks cash movement, it can make a genuinely good month look terrible and a bad month look great. Remember, cash flow is not profit. If your records are treating them as the same thing, decisions can get based on the wrong numbers. So how do we get the right numbers? We use the accrual method of accounting. What is accrual accounting? Under the accrual method, revenue is recorded when cash is earned, and expenses are recorded as they are incurred, regardless of when cash changes hands. This method is built around two key ideas. The first is the revenue recognition principle. It says that revenue should be recorded when the business has earned it, which is when the goods have been delivered or the services have been provided. The second is the matching principle. It says that expenses should be recorded in the same period as the revenue that they help generate. By matching revenue to related expenses, we can calculate profit accurately. Together, these two principles give us a clearer view of financial performance on the income statement. And this is what makes accrual accounting so powerful. It also allows us to track what the business is owed through accounts receivable and what it owes through accounts payable on the balance sheet. For these reasons, the accrual method is used by most large businesses since it's required by accounting standards around the world. But it has its problems too. It's more complex, so it takes more time and money to maintain, and it doesn't track cash flow directly. You'll need to do that separately on a cash flow statement, but that's a video for later. I think it's best if I explain this with an example. Imagine you run a bookstore called Lord of the Reeds. It's November, the holiday season is coming up, and you want to make sure your shelves are fully stocked. So you place an order with your publisher for $5,000 worth of books on credit. The books arrive, but no cash changes hands yet. Then December hits, customers flood through the doors, and you sell every one of those books. $7,000 in cash lands in your account. Great month. Then in January, the publisher's invoice comes due and you pay them their $5,000. So across these 3 months, you spend $5,000, you earn $7,000, so your profit should be $2,000, right? Well, that's where things get interesting. Depending on the accounting method you use, those same 3 months can tell a completely different story. Let's see what happens when we apply the cash method to Lord of the Reeds. Under cash accounting, the rules are simple. We only record transactions when cash changes hands. So let's go through this timeline month by month using the income statement. In November, we bought $5,000 worth of books on credit. No cash changes hands, so nothing gets recorded. The income statement is blank. Then in December, we sell all the books for $7,000. Cash is received, so we record $7,000 in revenue. There's no expense because we haven't paid the publisher yet. Profit for December is $7,000. Then in January, we pay the publisher their $5,000. Cash goes out, so we record a $5,000 expense. Profit for January? No, we have a loss of $5,000. So you see, the cash method is pretty easy to use, but look at what the income statement is telling us. December appears to be a cracker of a month with $7,000 in profit, but January is not looking so hot. There's a loss of $5,000. But nothing unusual happened in January. We just paid a bill for the inventory that we'd already sold. So, is there a better way to record these transactions? Indeed, there is. Let's run through the same 3 months using the accrual method and see what happens to the income statement. In November, we receive $5,000 worth of books from the publisher on credit. Under accrual accounting, no revenue has been earned and no expenses have been incurred, so the income statement is blank. Profit is 0. Then in December, we sell all the books for $7,000. The revenue recognition principle tells us that revenue should be recorded as it's earned. Well, we delivered those books, so we record the $7,000 in revenue. And the matching principle says that expenses should be recorded in the same period as the revenue they help generate. So we match the $5,000 cost of those books to the same month that they were sold. Revenue, $7,000, expenses, $5,000, profit for December is $2,000. Things are looking clearer. Then in January, we pay the publisher, but the expense was already recorded in December, so nothing new hits the income statement. Profit for Jan? 0. As you can see, we've hopped off the cash accounting roller coaster. There's just a clean $2,000 profit recorded accurately in the month we actually earned it. But the accrual method doesn't stop at the income statement. It also tracks what the business owns and what it owes on the balance sheet. Back in November, when those books arrived, the accrual method recorded $5,000 of inventory as an asset. And because we haven't paid for them yet, it also recorded $5,000 in accounts payable, a liability. The balance sheet is balanced before we've even made a sale. In December, the inventory is sold, so it's cleared from the balance sheet. $7,000 in cash comes in as a new asset. The $2,000 profit flows into retained earnings in the equity section, and the $5,000 in accounts payable is still sitting there because we still owe the publisher. Then in December, we pay the publisher their $5,000. Cash goes down by $5,000. The accounts payable liability is gone, and the balance sheet still balances. So we can use the accrual method to get a snapshot of assets, liabilities, and equity on the balance sheet. And it lets us check revenue, expenses, and profit on the income statement. But as you can see, there's a bit more work involved, and we've lost track of what's going on with cash. Remember, cash flow and profit are not the same thing. So under accrual accounting, cash flow needs to be tracked separately on a third financial statement called the cash flow statement, which, as it turns out, is a whole other topic. If you want to understand how cash flow statements work and how they connect to everything we've just covered, the video you're after is right here. Don't skip it. Plenty of businesses are profitable on paper and still run out of cash. I'll see you there.